everybody. Fundamental analysis is a big jugglery of so many different financial ratios. There are approximately 165 individual parameters when one has to look at a company just from the fundamental point of view. To add to it, there are more than 2000 companies listed just in NSE. That gives us an overall data point of nearly 3.5 lakh financial ratios and parameters from the fundamental point of view. Don't you think so? If there was a simpler method of identifying certain financial ratios rather than considering everything, and there was a measure to rate them or score them in certain parameter. Yes, today we are going to discuss about one such strategy which has been used by multiple fund managers across the globe even today. Please watch the video till the end. Welcome back. My name is Sumit Chanda and you're watching yet another episode of Be Your Own Fund Manager. Now, as I said, we are going to discuss about a fundamental strategy which will help you rate or score certain fundamental parameters in certain manner, which will eventually help you to create your own fundamental strategy. Yes, we are going to discuss about Petroski strategy. Now, as the name suggests, Petroski strategy was remarkably discovered by American accounting professor Joseph Petroski in 1979. Now, what does this strategy say? It primarily scores certain fundamental parameters of every company between 0 to 9. Now, any company which would qualify as anywhere as 0, 1, 2, 3 would not fall in the Petroski strategy, but all the companies which would qualify all 9 on 9 score will qualify within the Petroski strategy. Now, these strategies or these scorings were based on certain principles. Now, these principles were primarily growth, profit, valuation and management. How well the company is being taken care of, how well the overall operations are being taken care of, how well the overall revenue flow within the company is being taken care of. Petroski strategy is often referred as Petroski score or F score. So if you have ever looked at some of the research documents of certain companies, you would have come across a factor called F score. That is nothing but that's a Petroski score. So as I said, if it was anywhere nearer to 9, then the company actually qualifies. If it is anywhere nearer to 0, 1, 2, 3, the company does not qualify. So what happens in this overall strategy? So as I said, there are basically 9 parameters which the strategy looks at. All these 9 parameters are fundamental parameters. We will look at each of the parameters in depth. So the 9 basic parameters are primarily clubbed into 3 main sections. Now, what are these 3 main sections? Profitability, leverage and liquidity, and operational efficiencies. Now, as I said, these 3 main sections contains 9 different parameters. So let's look at each of the sections individually. Starting with the first one, which is profitability. So as the name suggests, it deals with everything to do with the profit that the company is earning year on year, how well it is able to manage that profits. So within profitability, the first primary criteria is net income. So the company, number one, has to have a positive net income versus the previous year, and it has to be more than the previous year. So both the years the net income has to be in positive, not in negative, and the current year has to be more than the previous year. Only then it qualifies for one Petroski score. Now the second criteria, which is operating cash flows. Now what is operating cash flows? So any company that is into business, obviously it makes certain amount of revenue from its basic primary functions. That is nothing but operating cash flow. Now how well the company is able to take care of its own expenses through the revenue that it generates within itself. That is nothing but is an operating cash flow. So this operating cash flow also has to be positive in the last 2 years, and the current year has to be more than the previous year. Then the third component is return on assets. Now this looks at how well the company is able to leverage its assets and the profits, how well it is able to return and reinvest its profits and the returns from its assets so that it is able to earn more out of the said assets and the profits. If it does well, obviously it qualifies for one more Petrovsky score. Lastly, we saw that obviously the net income has to be more than the previous year. We also saw that the operational cash flows has to be more than the previous year. Now the fourth parameter says that the operational cash flows has to be more than the net income in both the consecutive years. Now this would define the quality of earnings of the company. So that encompasses the entire first segment of profitability. If any company qualifies for all the four parameters, it gets 4 scores, or you can say 4 marks within profitability. The second section is leverage and liquidity. In short, the sources of funds. Now in this, it looks at how well the company is able to manage its long-term debt to total assets. And this ratio of long-term debt to total assets has to be improved than the previous year, which simply means that the company's ability to take care of its long-term debt should be improved from the previous year. If it qualifies, then it qualifies for 1 score. If it doesn't, it gets 0. Similarly, moving ahead, the next point here in this is current ratio. Now, current ratio is simply the ability of the company to take care of its short-term dues or short-term debts. If the company is able to take care of these immediate liquidities and the current position is better than the position last year, then again it qualifies for 1 more Petrovsky score. Then the third point is it looks at if any new shares have been issued in the last 1 year. If any new shares have been issued, then it does not qualify. But if there was no dilution and the number of shares are completely intact, then it qualifies for 1 Petrovsky score here. So simply means within leverage and liquidity there are 3 parameters, and a company to qualify for all the 3 parameters, it has to take care of its debts, it has to take care of its liquidity, and it has to ensure that it is not diluting unnecessarily. The third section is operational efficiency. Now there are 2 sub parameters within this section. The first one talks about gross margin. Now gross margin is nothing but the profit margin in simple language. Now what it simply says is that gross margin in the current year has to be more than the gross margin in the previous year. If it is, then it qualifies for 1 score. And the last and the 9th parameter is asset turnover ratio. Now what is asset turnover ratio? It is nothing but how well the company is managing, or what is the efficiency with which the company is able to manage its assets to generate revenues. It is a relative term to how well the company is able to manage its sales and assets to generate revenues. Like every strategy has its own pros and cons. And as we saw, the Petrovsky strategy very efficiently gives us 9 parameters, and it helps us rate those 9 parameters to find our desired companies. But then having said that, there are certain scenarios in which this strategy might not work, and I will also give you certain examples of it by the end. So this strategy will not work for a really long-term portfolio. So if you are an investor looking at creating a portfolio for 8 years, 10 years, 15 years, 20 years, this strategy simply might not work. Because what works for a company today, the ratios that it is able to maintain today, it might not be able to maintain similar standards as it moves ahead. It might not sustain the year-on-year growth or year-on-year efficient parameters across all the mentioned parameters continuously. So every 2-3 years you'll have to continuously check and recheck the companies that you're holding versus their Petrovsky scores, and you have to keep on churning your portfolio. So it is ideal for anybody who's creating a portfolio for say anywhere between 1 to 3 years or max 4 years, and then relook at your portfolio and just have a look at what Petrovsky score your individual stocks has. Second, it ignores multiple other quality factors of a company, the fundamental factors of the companies like the quality of the management, the products, the economic condition, the margins of the company, and many other similar factors which can actually elevate the growth of a company, but it simply ignores these parameters. Like in every video, we look at certain companies which qualifies that particular strategy, but today we are also going to look at certain companies which do not qualify in this strategy, and we'll also look at their relative performances. So first let's look at 3 companies which qualifies all 9 criteria, all 9 parameters of Petrovsky. Starting with Nestle. So Nestle qualifies all 9 parameters of Petrovsky. Followed by Adani Power. Again, Adani Power qualifies all the 9 criteria of Petrovsky. Third would be Glenmark Pharma. Again, it qualifies all the 9 parameters of Petrovsky. If you look at the individual performances of these companies, all of them, all the 3 have performed, given approximately 10% returns over the last 6 months. Now coming to the companies which do not qualify in Petrovsky, starting with Bajaj Finance, one of the most popular stocks today, attracts a lot of investors, has a Petrovsky score of 3. Similarly, look at Rosary Biotech. Again, one of the companies which has been favorite of many investors in the last 1.5 years, has a Petrovsky score of again 3. And lastly, there's another company called Trent, has a Petrovsky score of 4. Now, do you know what performance these 3 companies have given over the last 6 months? All the 3 companies have performed beyond 50% returns in the last 6 months. Now, why did I give you these examples? Simply from the point of view to explain that in certain markets, this model might not work. In certain markets and certain market conditions, the moment the consolidation phase ends or the market moves towards a stabilized economy, all of a sudden you will see the companies who qualify for all the 9 criteria of Petrovsky will start overperforming over the others. But in the current markets, it does not care. I hope you liked the video. You could learn something about the Petrovsky score. Next time, please do have a look at these individual parameters, try to score them, do your own research. And again, as I say, all the 6 companies I named are not from advisory perspective. It was simply for putting as an example. Please do your own research before getting into the equity markets. Thank you so much. Please like and comment.